Good day, students. Today's topic for learning is bank accounts. We will be learning about bank accounts, how to present the financial statements of a bank. All banks come under the Banking Regulation Act 1949. As per this act, they have defined and given the definition of banking. It is accepting for the purpose of lending or investment the deposits of money from the public repayable on demand or otherwise and withdrawable by check, draft, order or otherwise. We generally go to a bank, deposit money, deposit checks and we invest. The same way we also borrow loans and we draw money from the bank. So a banker always helps us in lending and also accepts our savings. So this is the main job of the banking. We go into the basic terminologies of the Banking Act. First one is accounting year. Every year 31st March will be the end of the year, accounting year. And then the next one is non-banking assets. By this we mean the assets which are given by the companies to the bank if the company is not able to settle their debts. If they have taken a loan and they are not able to repay it, some assets will be taken by the banker instead of the money which the company is not able to repay. So this will become the non-banking asset of the company, of the bank. Okay. Now we see what is a reserve fund. Reserve fund is the amount set aside by the banker. It is a mandatory or an obligatory amount out of the profits as per the Banking Regulation Act. Section 17(1). A banking company has to set aside 25% of their profits, which are disclosed in the profit and loss account. Non-performing asset is an asset that ceases to generate income for a bank. It is called as a non-performing asset. For example, a person takes a loan and he is not able to pay the interest as well as the principal within the stipulated time. Then actually he is a debtor to the company. He is not able to repay. Since he is not able to repay, it is called as a non-performing asset. Now we will be seeing how a financial statement of a banking company is prepared. It is prepared according to the Schedule 3 of the Banking Regulation Act 1949. It says it has to follow certain guidelines and follow certain schedules. Form A of Schedule 3 gives the format for the balance sheet. It has 12 schedules to be prepared, and the profit and loss statement is done according to Form B of Schedule 3, and it has only 4 schedules. In the Form B of the Schedule 3, we prepare the profit and loss statement. Here it is very easy to remember. We have only 2 incomes and 2 expenditure. The first and foremost income of any bank is the interest earned. Interest earned, we mean when people have taken loan and they are paying interest to the company, to the banker, then it becomes an interest earned. Or when the bank deposits some money in other institutions through which, or invests in other places, other companies, and through which it earns interest or returns, then it is interest earned. It is an income which is earned by the company. The next will be the other income. Other kind of incomes, we mean the fee or the charges which the banker imposes on the customers and is earning as a revenue or if it has any assets, and then through which it earns rent, locker rent, the DD commission which you pay for taking a draft, the income earned by the bank other than interest comes under other income. Okay, we go on to the next. Other income also includes any profit or loss on profit on sale of investment, then it is added, and any exchange transaction, foreign exchange transaction, revaluation of investments, all these are included in Schedule 14. Schedule 15, the interest paid or expended by the bank to the customers towards fixed deposit. If you have a fixed deposit, the company banker gives you interest. Recurring deposit, savings bank, current account, all these are accounts which are maintained by the companies and individuals for which the banker gives interest. Next we see the operating expenses. Generally, whatever expenditure which comes under the profit and loss account of any company comes under this as operating expenses. The regular administration expenses, office expenses, rent, taxes, lighting, salaries, wages, legal charges, depreciation, and so on. Under the provisions and contingencies, we see generally we write off bad debts. The customers do not pay some amounts, then it amounts to bad debts, and we also provide for bad and doubtful debts and provide for any contingencies which may happen. And it is also a provision for taxation also comes under this provisions. Once you add up 13 and 14, it is named as total income, and expenditures together, it is B, total of the expenditure. When you subtract A from B, A minus B, you get the answer of net profit, that is the profit of the current year. The current year profit and the previous year's profits, the last year or profit, will be added. That will be the total profit earned, that is the total C. From this, the company needs to appropriate. Appropriations is setting aside. I have already told you the statutory reserve is an amount set aside from the profit and loss of the company, banking company. We have to set aside 25% of the current year net profit. CYNP is current year net profit. We have to set aside to the statutory reserve. Then comes the other reserves, whichever it is mentioned. When it is mentioned in the sum, we need to provide for the reserves. Then the company, the banking company, they propose for the dividends to their shareholders, and the remaining will go to the balance sheet. This is all the preparation of the profit and loss statement. Thank you.